Welcome to the Fitch Ratings Fixed Interests podcast. My name is David Prowse. I'm joined today by frequent guest and occasional host of this podcast, Justin Patrie, head of the credit commentary and research team at Fitch Ratings. He's here to discuss the year ahead for global credit. Justin, you were the author of Fitch's 2025 Global Credit Outlook Report. What are Fitch's key views for global credit this year?
Thank you very much, David. There really is no singular narrative that works for the 2025 global credit outlook, or at least a simple narrative. On the positive side, there are continuing to be falling interest rates. There's capital markets momentum from a very bullish 2024 performance, generally strong corporate balance sheets, a resilient U.S. consumer, and a potential policy shift in China toward greater stimulus that could support growth there. But on the negative or risk side, there is a tremendous amount of uncertainty, especially related to policy and geopolitics. The incoming Trump administration will raise tariffs. This is a key part of his platform, and this is likely to or potentially likely to spur a global trade war. And there could be risks to the disinflationary trend in the U.S. from a potential policy combination of higher tariffs, tightened immigration restrictions, and looser taxes and regulation. It's also important to highlight the fragility of the global economy, with Europe's slow recovery lagging and China really not showing signs of a significant cyclical upturn. So even as the U.S. Seems to have avoided a hard landing, we still expect the U.S. economy to slow as well. So we're really not in the upswing of the global economic cycle.
Okay, we'll come to the negatives later, but first, can you delve deeper into the positive drivers for global credit?
Sure. So an important project our ratings analysts do at Fitch every year is they review the operating environment, macroeconomic forecasts, and major credit drivers for over 300 sectors. And they form views on the main themes, risks, and general outlook for those sectors. And for structured finance sectors, they focus specifically on asset performance. Each of these sectors is assigned an outlook that is either deteriorating, neutral, or improving based on what we expect the direction to be for the sector's core credit conditions or credit drivers. Now, that's a long-winded kind of sidetrack of saying that for 2025, the overwhelming majority of these sector and asset performance outlooks are neutral. And this is a notable evolution from previous years where the number of deteriorating outlooks was higher, and this is now steadily decreased to a fairly limited number. So part of this kind of neutralization of our outlooks is what you might call post-pandemic normalization, where some of the extreme supply-demand conditions, which resulted in an inflationary surge and then resulting monetary policy response, those are now receding. And we've seen that in ratings trends too. So rating outlooks, which indicate the likely direction of a rating over a 1 to 2 year horizon, they've steadily moved back to balance after being net negative from 2020 to 2023. The importance of interest rate cuts in loosening financial conditions shouldn't be underestimated. This has continued to be a key factor for global credit in 2025. Credit spreads are tight relative to historic levels, and while interest rates are higher than pre-pandemic, they're falling and refinancing conditions are generally okay. The continued resilience of the U.S. consumer and the fact that the U.S. is likely to avoid a hard landing is also critical for maintaining that broadly neutral outlook for global credit. Overall, even though we're not in the cyclical upswing of the global cycle, we're not seeing a major cyclical deceleration either. And at a time when borrowing costs are generally falling, this is all supporting our base case expectations.
You mentioned that most of the sector and asset performance outlooks are neutral. Are there any notable sectors that are improving or deteriorating?
Yeah, so there are some areas where we are expecting some change in general conditions this year. On the improving side, global aerospace and defense is a good example. The rise of geopolitical risk and an increased emphasis on defense spending among NATO countries resulting from Donald Trump's election is going to continue to be a tailwind for that sector. Structured finance digital infrastructure is another interesting improving asset performance outlook linked to the boom in data usage and storage and AI applications. On the deteriorating side, there are two key themes that stand out. The first is related to China and China housing in particular. We maintain deteriorating outlooks for China home builders, real estate, and engineering and construction. And that relates to the kind of continued lack of recovery in the housing market there. The other area of deterioration is North American structured finance asset performance, particularly in the subprime consumer borrowing segments and for commercial certain segments of commercial mortgage-backed securities. And this reflects some of the pressures facing certain types of borrowers from a cooling labor market and a higher borrowing costs. And of course, the secular disruption facing offices continues to be an issue for CMBS.
I don't think it's a controversial view to say that uncertainty is particularly pronounced this year. Can you go into greater detail on the major risks facing global credit in 2025?
Yeah, also not very controversial. I think the biggest and most immediate uncertainty has to do with the Trump trade agenda. If Trump executes broad-based universal tariffs to the extent he promised on the campaign, this would have a meaningful negative effect to growth in key trading partners and also threaten integrated supply chains in certain sectors. It could also be inflationary in the US. And if there is retaliatory action, it could spiral into a global trade war and weigh on global growth. Deregulation and tax cuts, though, could be positive for US growth and corporate cash flow. So the Trump agenda as a whole could be net positive for growth in corporate issuers, but that really depends on the region, the sector, and the calibration of the policy agenda as a whole. I think I've mentioned this before, but also it's important not to forget the fragility of the largest economies right now. Bullish capital markets have kind of obscured that global growth, while not significantly decelerating, is still expected to decelerate in 2026. Both China and the US are forecast to decelerate. The Eurozone is really the only one of the three largest economies that is in a cyclical upturn, but their recovery is forecast to be weak, and we forecast their growth to be just 1.2% in 2025. So overall, we're not in the acceleration phase of the global cycle, and really this is the point at which vulnerabilities are more likely to be exposed.
Given the many themes you've talked about, what are the main things you'll be watching this year that will be meaningful for the trajectory of the global credit environment?
Yeah, so when you're looking at global credit, that's a very big, diverse world. So I'm sure I'm missing some themes. I'm sure I might be emphasizing some that might need to go down a little bit, but I've narrowed it down to, I think, what I consider the top 5 or 6. So the first, the Trump policy agenda. This is obviously a key variable to watch. Trump's election is significant. It is going to mean change. Tariffs, taxes, regulation, immigration, foreign policy, these are key areas where we're likely to see meaningful change to U.S. policy. The second is U.S. inflation. So inflation is obviously the driver of monetary policy, so interest rates are going to be sensitive to changes to the U.S. inflation outlook. The third is U.S. consumer resilience. This was the big surprise in 2024, and so the extent to which the U.S. consumer continues to spend and continues to benefit from a relatively tight, though loosening labor market, is going to be key for a large number of sectors. Any surprise on the downside or the upside is going to matter. The fourth, European households. The Eurozone recovery arguably is disappointed in 2024, and in part this is on weak household confidence. So watching household savings rates, consumer behavior in Europe is going to be key there. The fifth, Chinese stimulus. The Chinese government has increasingly been focusing on growth-oriented policy statements since, I'd say mid or early fall last year. So 2025 is really going to be the year where we get to see how this is going to be executed and play out. And the sixth is geopolitics. So we are in obviously a very tense global geopolitical environment where escalation of tension spots and existing wars could very easily occur. At the same time, we could also see some sudden détente and resolutions. But overall, geopolitics is going to continue to be kind of a potentially key pivot point, either on the positive or risk-oriented side in 2025.
Thank you, Justin, for sharing your thoughts on this week's Fixed Interest podcast. And as always, thank you very much to our listeners and subscribers. If you'd like to learn more about Fitch's credit ratings and credit views, including a look at the 2025 Global Credit Outlook Report, please visit our website at fitchratings.com.